Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about CLOs with Richert, a CLO portfolio manager at Poland Capital. Previously, Rick held other CLO portfolio manager positions at Soundpoint, American Capital, and a few other firms. He began his career at MetLife. He got his BS from Southern College and his MBA at the Ross School. So welcome to the podcast, Rick.
Thank you.
So we do this sort of zero in on a couple of subsectors along the lot. But when we first started talking about this, I was like, CLOs are complicated. So let's talk about what you see as the most important things that are pushing CLOs in the direction they're going now. What are the bigger trends pushing around?
Yeah, sure. So CLOs have been around for 30 years. And I think really the latest catalyst for higher popularity and growth and acceleration of growth is really us coming out of the ZIRP environment, right? So we were in ZIRP for 15 years, and everybody very much remembers what happened in 2022 with lots of losses in lots of different portfolios. But the Fed took rates from 0 to 525 very quickly, right? Disrupted bond markets. Didn't matter what you held. Treasuries were down 10%. High yield was down. Lots and lots of things were down. CLOs are floating rate. Right, and so a great aspect of that, caused the resilience. I think it was one of the few asset classes that was not down in 2022. And I would even suggest that the banks that went under, the couple of banks, Silicon Valley Bank, Signature, in early 2023, might not have gone under if they had owned a lot more AAA-rated CLO debt.
Right. Or done some basic stuff they teach in the first week of MBA.
That as well. Yeah, that as well. That as well.
There are a few other factors there.
Sure, for sure. I do agree with that. But I think people are realizing that it's just a very, very resilient asset class. I think also it offers investors many different return profiles. So when you say CLO,
it means many different things, right? Yeah, well, that's what I thought.
Exactly.
When we were preparing this, it's like, what are we talking about?
Exactly. So there's 5 different debt tranches that give different returns, right? AAAs are really AAAs. No AAA in the history of the 30-year market has ever impaired, 1 cent, has never had a loss. Same for AAs. And AAAs are, varies the rate, but you get risk-free plus about 130. Today.
Okay.
So nice, super resilient, good yield, cash equivalent, and you're never going to lose money.
So, but that spread has been narrower in the last couple of years, right?
That's right. Yeah. It's ranged from 95 to upwards of high 100s.
Okay.
Over time.
Okay.
And so if you go down the stack, the AA, the single A, the triple B, and the double B, you can get more risk, more return, right? So double Bs, as the extreme example of that, 5 notches down from AAA, give you about 550 over SOFR.
Okay.
And so that's a 10%-ish yield. The really interesting tranche in my mind is the equity. Equity also, it's the residual, right? And the equity is getting paid just from the arbitrage between what you're earning on the loan portfolio and what you're financing on the debt side.
Mm-hmm.
But it also has no duration risk, no interest rate risk, because both things in that arbitrage are also floating rate.
Right.
So it's protected from that aspect. And that, over the long term, has yielded 15%, 15% cash-on-cash returns per year. So really, really attractive asset class in our view.
Yeah. I mean, this is one of the reasons I thought this was interesting, because some people are expecting rates to go up.
Sure.
Or at least stick around here for a while. So this is, as you rightly said, the things that happened in the long bond were sort of unprecedented, and and happened again in March. So there's a lot going on here now. Some of this is from good old fashioned diversification.
Absolutely.
Right? So can we talk a little bit about what underpins that? Because there's a diversification factor. There's it's like a buffet style thing. You can choose the one you want, but let's talk about the diversification factor in there.
Yeah, that's absolutely true. Why can you rate a pool of loans that constitute a B2 average rating into tranches that result in AAA as part of like 60% of the stack of the debt, right?
Yep.
One of the biggest factors is exactly that, diversification. So it's calculated both ways, from issuer, how many names do you have in a portfolio, and A portfolio can range from 200 to 250 is the general context. And then what is your diversification across industries? I will tell you if a CLO ran 15% in energy, they're probably going to blow up every once out of 7 years.
Right.
So it's very, very, very prudent to run a lot of diversification across industries as well. That goes into a calculation called the D-score, the diversification factor, combination of issuer and industry diversification.
D-score, I think, is on level 2. So everyone listening to this podcast studied it at some point.
There you go.
So, okay, so let's talk about fund management here, because that's the other sort of factor in this is as the risk and return profile go. So you've been around for a while. You've seen lots of different management styles. What do you think is the best in class?
Yeah, so I think it's an interesting question, and I really start by stepping back and saying, what does the risk profile look like of the collateral that is building a CLO, right? So the leverage loan, what is the profile there? We tend to buy almost all of our assets right around par.
Uh-huh.
That can trade up to 101, 101 and a half, or down to 0.
Right.
That's what a leverage loan's price profile is, right? There's no convexity because there's no interest rate risk. They're all par callable.
Right.
Outside of 0.5% that have some non-call protection, but the vast 99.5% are par callable. So it's interesting and very different than running an equity portfolio, because you can sustain some losses running equity because you're going to have some doubles, you're going to have some triples to make up for that. Yeah. You are never going to have a double in a leverage loan, nor are you going to have an asset that goes to 105 or 110.
Right, it's going to get called first.
That's bonds, but loans don't do that, right? Yeah. So just think about that risk profile. It's super asymmetric to the downside, right? My upside's 101, my down is 0.
Right.
Now, 0 is rare, right? 0 is usually fraud or something around fraud.
Right.
The average recovery over the long 30-year history is 70. More recently, I'd probably argue 60 or 65 is the better. So really, practically speaking, your upside is 101, your downside is sort of 35 cents, but still asymmetric to the downside.
So just pause there for a second. That's a pretty decent recovery rate. I didn't realize it was that high. That's higher than munis.
Sure.
Right. That's pretty high for bonds, right?
And if you really go back 30 years before documents got very aggressive and loose, and there was a lot of lender-on-lender violence that was starting to occur, which really didn't happen 20 years ago, the answer was 70 cents. And it's simply because you have the first lien call on all the assets of the borrower. So you always wind up on top in a restructuring. That's been diluted. It's well known about the aggressive LMEs. That's a whole nother subject.
Right.
But yeah, the recovery rate is I think the way to think of it is closer to 60 to 65 over the long term.
Okay.
Yeah.
Great. Sorry, please continue. I just wanted to zero in on that for a second.
No, absolutely. Yeah, good point. And so if you think about that profile, how are you supposed to manage a pool of risk with that profile? I very strongly believe it is up in quality, up in liquidity, risk management foremost, risk management number 2 most important, and risk management the third most important thing. So it is really about that, right? Because you have no huge gainers that you're ever going to have that can offset a loss. So let's not have losses.
Right.
And so we are running a platform at Poland that very much speaks to that. We're building portfolios with 0 second liens, 0 triple Cs, average tranche, $200 million higher than the average CLO manager out there. Lower wharf, just better liquidity. And liquidity you need to sort of dig into too. It's not just how many dealer quotes and what's the tranche side. It's how is it syndicated? What hands does it really reside in? Is it going to be a liquid loan?
Right, and that's the margin in risk management, right? That's the part that's hard.
All of that is, and I find that if you're an active trader and you're the first to be out when something goes wrong from your thesis, that also gives you a leg up on your competitors.
Okay,
so we're not reaching for yield or for triples or home runs or excess returns. We are building a platform that we expect to have an equity return promised here, and we intend to deliver the tightest distribution around that promise.
Right.
That is how we will measure whether we have a great franchise or not. How tight is our distribution around our equity promise?
Okay. I just want to go back also. You rather coyly dropped in WARF there. That I think is not on the CFA exam. Could you talk about what WARF is for a second?
Oh yeah, it's quite simple. It's just a way to quantify Moody's corporate family ratings. And so, a B3 is 3490, a B2 is 2720, and so forth and so on. So you aggregate your pool of loans using that quantitative measure to come up with one aggregate number.
Yeah,
That's right.
It's actually an easy calculation. It's just something I think that most people outside of this sector don't run into very often. So Google it, folks. It's out there. When you look at risk management, how do you divide up the world of the different buckets of risk, and how do you guys kind of crack that?
Sure. I mean, the key risk that you're long in a CLO structure is loss given default. So I want to stress loss given default because you can have defaults that recover par. That's a marketing problem. It's not an economic problem.
Right.
So you can't have those.
Right.
You don't want them, but they're not going to really hurt you,
Right.
Other than marketing. So it really is preventing losses, right? So this is many things that are included here. First, it's your initial construction. Are you diversified? Are you in the right sectors? Are you in the right names? We tend to avoid the deeply cyclical names like, land rigs in oil or E&P is highly, highly cyclical. So we're going to be amongst the lowest weighted to that sector. And then we tend to emphasize things that are more resilient, have recurring revenue, very strong cash flow, right? So it's how do you build it up front? Is it built to be resilient through a default cycle, right? Because, again, the biggest risk is corporate defaults and loss given corporate defaults. And then how do you monitor it? Monitoring still remains a little bit, I think, underappreciated across all managers. Yeah. And I think that's 70% of the game.
Oh, okay.
I think you have more managers that can build it nice up front. And way fewer managers that can keep it resilient through a 6-year time horizon.
Okay, so that's exceptionally interesting, and also I think it makes kind of sense. So how do you all do that? I mean, are you using AI to augment some of your monitoring, or how do you make that sausage?
So it starts with having a great team. You need senior analysts that know their industries really deep and well. It starts with intense monitoring and processes that allow for intense monitoring. Maybe that's a little too long to talk about exactly what we do, but it is a bit proprietary.
Yep.
We have great AI capabilities in-house, and not only does that allow some citing of good trades and relative value swaps, what you haven't asked about is risks that I see in the future, and I do think AI is on both sides of that.
Okay.
It's providing good things,
yeah,
but it is also going to probably create market share shifts amongst borrowers that analysts need to be aware of.
Okay, let's dig into that for a second. So, because do you think that because it is also obfuscating some things?
I think AI generally is a positive corporate force, meaning that the biggest attribute I see in it manifesting is increased productivity. Right. We're already utilizing that. It's a fantastic junior lawyer as an example.
Yep.
I don't really need a junior lawyer any longer.
Or perhaps a junior analyst also.
Maybe. Exactly. Yeah. And so lots of efficiencies there. But I think it's going to affect every industry. And that's what not everybody realizes now. So how do you teach your power generation analysts to appropriately factor in all the AI transformations that's going to occur in that industry? Now, that industry actually is relatively easy to see one aspect, that power generation prices are going up because AI is more energy intensive.
Right.
But healthcare, just basic industrials, chemicals, I can't really think of a sector that there's not going to be some impact.
Right.
So it's having analysts kind of do that research, that thinking, use our expertise in-house to get smarter on that thinking and figure out which companies are going to gain market share
Right.
at the loss of market share on other companies. And you don't want to be in the ones that are going to be losing out on that equation. It's not an easy thing to figure out,
Yeah.
for sure.
Yeah.
But you need to be mindful of it. You need to be thinking about it, and you need to be incorporating it into your credit views.
Yeah, I would guess this is challenging from a portfolio management perspective because they're still pretty early on in that procedure.
Absolutely.
Yeah, so picking the winner out of this is not easy.
That is correct.
Yeah. So beyond AI, what do you think are the other risks right now? There are leveraged loans as a whole.
Yeah. So I think most good CLO managers can manage through in a very acceptable way the typical risks, right? The corporate losses, the industries. There have been occasions where people have overweighted energy, and that has usually burned them. So people do make mistakes. I think that's a small segment of the CLO population. What I think about is more the in the weed risk that isn't talked about as much. And I've had 30 years of managing teams and credit analysts, and it's things like the human bias for an analyst to be too vested in a particular name.
Right.
And they can sometimes know the name so well that they feel like they're such an expert that it somewhat blinds them to the risks through the cycles.
Right.
And they're kind of over-invested in that particular name succeeding. So these are human tendencies that I think really good managers need to pay attention to, evaluate throughout their team, figure out who might have that tendency, who might not, and try to adjust for that in your management. So it's things like that are very nuanced that I think ultimately create a good bit of the alpha.
Really? I mean, that's fascinating because it's essentially management, right? It's it's essentially a heuristic.
Yeah.
That's fascinating. Well, perhaps we could have you back for a different podcast in which we talk about how to structure your team and how you structured your team. But that will have to wait for another time. So
happy to do it.
So thank you, Rick, for being here and speaking with us.
You're welcome.
And thanks to everybody for listening into this podcast. You can find Rick on various internet places if you're interested in hearing more about what he thinks about the long run risks are. That last one really tripped the light. Fantastic. And thank you all for listening to Compound Insights. Until next time, I'm Rob Rowan.